Hello everybody, good evening. Welcome to JAIIB English Medium channel. Today in this particular session we will be talking about principles and practices of banking. Now as you know that the JAIIB exam is round the corner. In the May month we will be having the examination started for our first examination cycle of 2026. So now what we should do? We must focus on whatever we have read till now. We must try to consolidate the things whatever we have done, because now is the apt time in order to have the first iteration of revision. And if you have not revised till now, do not worry, we are here to help you out via various sessions on YouTube as well as via our paid classes. So today the principles and practices of banking, since you must be knowing if you are following this series that we will be covering the one of the most important chapter of your module B. So when it comes to the operational aspects of loan accounts, it is more or less parallel with the deposits. Fine, we have seen in module A the operational aspects of your deposit accounts, how the deposit accounts operate, what all entails to the operational aspects there. Here also, since module B talks about the advances section of the bank, here we'll be learning about the loan accounts. So first of all, we will be doing the basic introduction, what all topics are there in this unit, and then one by one we will be trying to have them clarified for all of you. So first of all, when we say that operational aspects, the aspect of your loan account. So a loan account functions like what? It has one of the major, you can say, parameter as the interest rate. So we will be starting off the operations via deciding the interest rate, and how this rate of interest is decided by the banks. That is what is known as your major operational aspect of the loan account. And in this entire unit you will find good introduction of the rate of interest. After that we will be moving on to the credit monitoring also, the management of the credit also, but starting point will be the rate of interest. So we will be learning what all types of interest rates are there on the loans. Now by type we mean the base rate. It all started off with the base rate in our country. Then we have the MCLR, the benchmark decided by the banks within themselves. Then we have the external benchmark rate. So EBLR is there, decided by the RBI. So linked directly to the repo rate. And you must have heard that in your respective banks it is also known as RBLR, the repo based lending rate. So more or less the nomenclature differs, functionality remains the same. Fine. Next important you can say topic is your credit management. You will be learning that how the credit is managed once it has been apprised, once the sanction has been done. So management will be done along with the monitoring, that whether the loan account is showing any sign of bad asset or not, whether we have to be careful while looking into the stressed accounts, or for that matter whether one particular account is falling under the SMA category or not. If it is falling, then what we have to do. All these things we will be learning in the credit monitoring. Plus also various types of agencies are also discussed here, the most important one being your Central Repository of Information on Large Credit. So CRILC. If you are learning, or for that matter doing self-study, then I would highly recommend do not ignore this particular topic. Question will be asked from this particular topic, and that too from the limit. What do we mean by this large credit? What is the amount involved in this particular type of agency? Then comes the common operational terms, the aspects related to loan functions, various terms, terminologies you will be learning in this particular topic. Then how you handle the loans. Fine, starting off with the sanction, of brief introduction will be there to again sanction only. Then how the documentation occurs, because ultimately if you want to recover some amount of you can say interest or principal, then you must have foolproof documents. So documentation is also one of the very important aspect when we talk entirely about the operational process. Then comes the accounting aspects of the loan products, how we tend to calculate this interest, how we calculate whether we will be giving the loan to a customer or not. All these are what? These are the accounting aspects we have to calculate based on various ratios. Fine. All these ratios you will be learning when you will be handling the advances section as well, because based on these ratios only you will be not only appraising the loan but also giving an enhancement to the loan limit. Basic operating instructions on the loan product. So we have various loan products: personal loan, we have business loan, we have MSME loan. What all important salient features are involved in all those types of loans, how they are distinguished based on the basic operating procedure. Then operating manual for the loans and advances, what all the bank policy says, or for that matter what has been stipulated by the regulator, that is RBI. Then there will be some sample operating instructions. We will be learning that how when you are providing advance against some goods to a particular business entity, what all steps will be involved. So step 1 will be what? You will be appraising the loan. Step 2 will be providing the information about the loan product to the customer, or for that matter business entity. Third one will be what? We will be doing the final documentation, and we will be having the acknowledgement from the customer as well. And after that starts the NPA your credit monitoring, or for that matter NPA management. Then sample will also be there for the advances against WRs, your warehouse receipts. What are these warehouse receipts? How the negotiable warehouse receipts, they differ from the E and WRs. All these things also subsequently we will be learning in various chapters. Then comes the operational aspects of some common loan products. So there will be discussion around the educational loan and the vehicle loans, because most of the bankers initially they will be learning about these loans only. They will be handling these loans only in their branch. Right? Then comes the guidelines on recovery agents engaged by the banks. So recovery agents, or for that matter you can say the debt recovery agent, DRAs, what all is mentioned by the RBI and what all compliance has been done by the respective banks. Lastly, we also have the fair practices code for your lenders. So all these pointers are very important when we talk about the examination perspective of your unit number 24. Right? That's how you must break down each and every topic to subtopic and then start studying. Otherwise, you will not be able to appreciate the process flow. Fine. Now, we will be starting our discussion with the basic thing, that is interest rate. Interest rate, as you know, that it is being decided somewhere down the line by the market forces, but the implementation of the same will be done via the RBI's monetary policy. RBI is very much keen to decide a benchmark rate known as repo rate. Now, whether the banks will be following that rate or they have their own simplified or complex method for the same, we'll be learning that in this particular discussion. So it all started with the genesis of your base rate. Earlier BPLR was there, but we will be starting our discussion with your base rate only, because that is from where the questions will be asked. But nonetheless, you must also know that who was chairing this particular committee which recommended to shift from your BPLR to the base rate mechanism. So Reserve Bank Working Group on Benchmark Prime Lending Rate, the chairman was Deepak Mohanty. So this particular committee's name and the chairperson's name you must remember. So it all started with 1st July 2010 when we had the base rate, and this base rate was ultimately, you can say, transformed into another mechanism known as MCLR. So MCLR, the internal rate as we call it today, fine, the internal rate of the banks, fine, which we will be learning in this particular subject of PPB also, and in IE and IFS. In IFS also you will be learning about the MCLR and the difference, the point of difference between MCLR and your EBLR. Fine. So both these subjects, they cover some aspects of MCLR as well as EBLR. So base rate was modified, or you can say it was done away with, and we got MCLR with effect from 1st of April 2016. Now you must be wondering that why we are shifting from BPLR to base rate, then base rate to MCLR. There must be some reason. Na? So we will be learning about the reasons also, but just to give you an overview how the things worked out over a, you can say, time period of 10 years, that is the flow which I am giving you here. So MCLR further was shifted to external rating, or for that matter external benchmark, that is EBLR, with effect from 1st October 2019. Now when I say that we shifted from MCLR to EBLR, that does not mean that we are not or no longer using the MCLR. In 2024, I think the second last financial quarter of 2024, one report was published for Indian banks only, that most of the banks, they still are utilizing the mechanism of MCLR to decide their rate of interest, and that is the area where RBI wants to change, or for that matter modify the regulations. So RBI wants every bank to be in line with the EBLR, but yes, apart from the major banks, most of the banks, fine, the medium or the small banks, they still use the MCLR for the calculation of interest rate. Now let's talk one by one about all these, starting off with base rate. Prior to base rate, it was BPLR, and BPLR, who was the, you can say, which committee, or for that matter who was the chairman of that committee, due to which or based on whose recommendation we saw the shift from BPLR to base rate, it was the Deepak Mohanty committee, fine. So benchmark prime lending rate shifted towards the base rate, and this base rate, more or less, what is the funda here, what was in fact the funda, now though nobody uses the base rate. See, for example, let me just give you one situation. There are two deposits, fine, two deposits are there in your bank. Let's suppose in your branch only. Deposit 1 was done in 2025. So first one will be 2025, where you promised the customer that on rupees 100 of deposit, you will be getting what? 7% as the interest rate, just for the example, fine. Second deposit, let's say that by the end of 2025 or beginning of 2026, this particular rate of interest has been lowered by the bank to 6%, right? Now when I talk about the today's number, fine, supposingly somebody asks me that as on today, or for that matter 16th of Feb, what will be the interest rate on these two deposits? So the interest earning for the account in 2025 would be what? 7 rupees, and your 2026 will be 6 rupees only, right? And when I calculate the base rate, I do what? I do the average of all such kind of rates, the previous rates as well, previous rates included. And that gives me what? The average will give me the interest earning as 7 plus 6 divided by 2, which will come out to be what? 13 by 2, or for that matter 6.5. And that should be the interest earning for all the accounts. But do you think this is the real picture? This particular calculation is showing you the real picture? Answer is no, because here the average states 6.5, but you have promised what? Only 6% or rupees 6 as the interest earning for the customer in the account that was there in 2026. So the banks, which are there to benefit the people only, but their primary motive is to make profit. That profit maximization was not there because of this base rate. So that was the prime reason why the banks shifted from base rate to MCLR, the marginal cost. MCLR, MC stands for marginal cost, and that particular marginal cost of funds was calculated based on a singular formula, not this average formula, fine. So base rate, more or less, the basic norms of base rate system, they were floating rates, rupee loans sanctioned and renewed between 2010 1st July and 31st March 2016 were priced with reference to the base rate. Fine, the rate at which you have prescribed a particular interest on a particular date for a particular account. Everything was related to a single account. No comprehensive measure was there. Only one base rate for each bank. So if a bank is following this particular average, they are what? They are incurring some losses. Banks were free to calculate the cost of funds. So when the banks, they calculated this cost of fund based on the average, again I would like to reiterate that they faced the losses. The base rate methodology was not to be reviewed for 3 years from the date of its finalization. So that was one of the reasons why the banks were unable to change it quickly, because on the implementation day itself, it was mentioned that after the 3rd year of its implementation, you would be able to change the mechanism. So more or less the same rate will be there till 2013, right? As of July 2012, following categories of loans could be priced without the reference to base rate. So some exceptions were also given, like we have the DRI advances, differential rate of interest advances, advanced to some weaker sections, fine, weaker sections of our society, in order to give them some interest benefit. So you cannot link your base rate, your profit rate, because banks are there to make profit, and you are making it the bank's free will to charge any kind of rate of interest. So yes, weaker sections, no, you cannot do that. Loans to banks' own employees, including retired employees. So if you want that, yes, only 1% rate of interest should be charged to our dear bank employees, so that also you cannot do. Then loan to banks depositors against their own deposits, in order to favor the depositors, some set of depositors, some group of depositors. If you want to do this thing, that is also not allowed. Then loans where interest rate subvention was available. Already we are providing, the government is providing subsidy. Why do you even require the base rate there? Right? Then loans where the refinance is availed. So refinance means what? You are already trying to have an alternative route to finance your particular dues. Fine. So loan over loan, not at all possible. Okay. So these were the categories of loans which were exempted from the base rate mechanism. Base rate was to be reviewed at least at quarterly intervals. So review will be there, but change was not at all there till the 3rd year, 3 years from the date of its finalization. It was required to be made public also. You must tell the public, fine, have the rate listed on your website also. No loans except those mentioned in this particular list, they can be exempted. Fine, only these types of loans were exempted from the entire base rate mechanism. Okay. So yes, this was the basic clause of base rate. Now, when you talk about the calculation, how we used to do it? Simply stated, average return on the net worth. This calculation, the average calculation, was only performed to calculate the base rate or arrive at the base rate. And when we talk about some more pointers, the card interest rate on retail deposit, the deposits below 15 lakh with 1 year maturity, you can have the base rate aligned to this particular interest also. Fine. So the card interest rate on retail deposits with the amount that is less than 15 lakh, you can directly align it with the base rate for the base rate calculation. Adjustment for negative carry in respect of CRR and SLR. So what is this negative carry? You won't only see this negative carry in the base rate, but also in the calculation of MCLR. So once and for all, let's try to decipher what is this negative carry. So negative carry is nothing but the profit which you have foregone. Fine. You have foregone the profit. How? Because the amount which is being withheld as the reserves. Fine. You are holding your money, the bank's money only, as reserves in CRR as well as SLR. So rather than holding them as reserves, what you could have done, you could have provided this particular money which is held with CRR and SLR reserves to the general public, to the business loans, and would have earned the profit via the interest earning. Banks also earn the interest. So yes, this was the basic funda of your negative carry, that you are not utilizing the positive impact of the funds you are holding. Instead, you are doing what? Something negative on your balance sheet, and that negative is known as negative carry, which is in respect to the CRR as well as SLR. Then we have unallocated overhead cost for the banks, which would comprise a minimum set of overhead cost elements. So there will be certain costs which are not at all directly allocated to the banks, but overhead, in the overhead expenses you will find the reference. So more or less these are the points which are there while calculating the base rate, but the most important one is your average return on the net worth. Okay, so the earning of the bank, you will be doing what? Average and providing the stipulated rate of interest. Now comes the third type of rate of interest mechanism, which was developed in 2015. That is your marginal cost of funds based lending rate, or for that matter, we also call it as MCLR. Right? So December 2015, the RBI reviewed the norms for determination of your base rate and introduced the marginal cost of funds based lending rate, that is MCLR concept was there. And when we say that MCLR was introduced, whether this particular concept was a hit or not, initially RBI thought that yes, it will be beneficial for the general public, for the larger public of India, but ultimately when the banks failed to transmit the benefits of repo rate to the public, then MCLR was again considered as a negative connotation for your banking sector. So then we saw the EBLR, right? EBLR mechanism was there. So RBI reviewed the norms for determination of base rate in 2015 and introduced the MCLR. In March 2016, master directions issued by RBI, interest rate on advances, the directions name, it was issued, and the provisions of these directions apply to the scheduled commercial banks, excluding the RRBs. Fine, RRBs were not under the ambit of this direction. Small finance banks and your labs also, that is local area banks. Also, they were not at all applicable on the operations of foreign branches of Indian banks. Fine. So Indian banks having the branches within India, you will be following the MCLR, but having the branches abroad, no, not applicable. Okay, next comes the MCLR basic norms. Like we have discussed the basic norms of base rate, now let's talk about the basic norms of your MCLR as well. So all the floating rate rupee loans sanctioned and renewed with effect from 1st April 2016, you will find them under the basic norms of your MCLR. When the external benchmark rate is required to be adopted, such advances will be excluded. Fine. External benchmark means the benchmark rate decided by the RBI. When you are deciding the rate of interest based on the external benchmark, you won't be applying, or the MCLR is not applicable. Banks are required to publish at least 5 MCLRs. What 5? So 1 month, 3 month, 6 month and 1 year MCLR. Also, when we talk about the overnight MCLR, that is also under this particular 5 types of MCLR. So overnight, 1 month, 3 month, 6 month and 1 year. Fine. So overnight, 1 month, 3 month, 6 month and we also have 1 year. This information you must remember, they can ask 0.5 marker question from here, right? So banks are indeed required to publish all these types of MCLR, the duration of each MCLR. Banks are free to publish MCLRs for longer duration also, fine, longer maturity. Each MCLR is to be reviewed every month on the pre-announced date. You will be announcing the date for the review mechanism of your MCLR, and then only you can review the MCLRs for that particular period, fine, the maturity period, whatever you have decided. Now comes the methods of assessment of the loans, fine. How you will be assessing the loans based on various benchmark. But before that, let's just talk about the difference, the point of difference between MCLR and EBLR also, because in order to make the continuity, we have to learn about the EBLR as well, fine. So EBLR, more or less you will find that it is linked to the RBI's lending rate, right? The repo rate which we talk about, that is more or less linked with the benchmark. It acts as a benchmark here. So MCLR, again, it replaced the base rate which was there till 2016. Since 2016 we have MCLR, and based on Dr. Janak Raj committee's recommendation, we got EBLR since 1st October 2019. So when we talk about the MCLR, it is linked to bank's cost of funds and has a total of 4 components. Fine, there will be 4 components, starting off with your tenor premium. You have the operating expenses, then negative carry is also there, plus the final profitability. For EBLR also you will be having 4 external benchmarks, but mostly you will find that it is based on the Reserve Bank's repo rate. Apart from that, you will be having the government securities as 2 of the benchmarks out of these 4. So one is repo rate, then we have the T-bill maturity, the maturity amount which is published by a private agency, and the 4th one will be whatever that private agency, FBIL is the name of the private agency, that particular private agency wishes to publish, but more or less that won't be direct intervention of the FBIL. You will see the 4th parameter, whatever is being recommended by the RBI or Government of India. Fine. For that we will be learning more deeply in IIFS subject. Here just focus on the difference, the point of difference itself. So when you talk about the MCLR, the minimum interest rate at which the commercial banks can lend, it takes 6 to 7 months to come into effect, and that is the reason why RBI keeps on emphasizing on mapping the entire banking lending rate with the EBLR, which responds immediately to RBI's rate cut. So right now this monetary policy committee, we have seen no rate cut is there, but previously there was a rate cut, so that was quickly transmitted by the major banks. I personally have monitored SBI and HDFC, and they have within 7 days transmitted the rate cut to the customers in the form of cutting down the rate of interest for the various loan accounts. Also, when we talk about the MCLR, it resets annually for most of the banks. Annually, you will find a reset will be done for the MCLR, but here after every Monetary Policy Committee recommendation, you will find that reset will be there. Mostly it is what? Within 3 months. Monthly revision will be there. Yes, MCLR will be revised, but EBLR is not revised monthly. It is reviewed by monthly by the Monetary Policy Committee. In MCLR, since the transmission takes more time, 6 to 7 months, so it is low volatile. The volatility is quite low as compared to the highly volatile EBLR. Fine. So yes, these are the points which you must remember for the point of difference between your marginal cost of fund based lending rate and external benchmark based lending rate. Very important. Okay, now let's move on to the remaining topic which we were discussing. That is your method of assessment of your loan. So how you assess a particular loan account, fine, that we will be learning via this particular slide. First of all, for the MCLR, you have various you can say parameters based on which we decide the benchmark. Right? Why we are not studying about the base rate? Because now it is redundant. Now you should only focus on MCLR and EBLR. So the review mechanism of MCLR, banks shall review, publish their MCLR of different maturities every month on a pre-announced date. Review of MCLR done, fine. On pre-announced date, you will be telling the public that yes, this will be the review date, and then you will be reviewing the MCLR. If you want to change it, you can. Banks need to have a policy for charging the spread to the customer based on various defined components and the delegation of powers for pricing of the loans. You have various loans, fine. Home loan is there, MSME loan, the small loans, the big corporate loans, project finance is also ongoing. So for that, you will be having fixed type of delegation of power also, that which authority will be providing you rebate, if any. Main components will be, first of all, we want to have a business strategy. What do we mean by business strategy? Increasing the profit. Profit maximization is the soul of your method of assessment when it comes to the MCLR. So it all starts with the business strategy. Yes, what kind of profit you want in this particular quarter or annual. Then we have the credit risk premium or the tenor premium. We also call it tenor premium interchangeably. So the spread charged to an existing borrower shall not be increased except on the account of deterioration in the credit risk profile of the customer. So what is the risk we are talking about? Fine, credit risk premium. See, whenever you are lending somebody some amount of money, you are A and you are lending money to B, who is your friend. Now you have lent B, let's suppose rupees 1000. Okay, and this 1000 rupee is what you expect from B to be back by, let's suppose, 1 month. Within 1 month, B will return the money. Okay, so you have not charged anything to your friend. But if I charge a nominal amount, that yes, since I have lent you rupees 1000 and now the value of 1000 rupee has increased to, let's suppose, 1001. So return me this amount, 1001 rupee. This is what the amount with a nominal interest, the basic interest we call it. But when I try to add my profit in this particular transaction, fine, my profit, and by profit what I mean, that since I have lent you 1000 rupees, if I have provided this amount of money to my corpus, fine, to my corpus, where I am investing in various mutual funds, then it could have grown, let's suppose, 5x. So give me my profit also for that time period. Then you are charging what? The interest which is linked to your profit. Fine, the projection, the profit projection. And that is what we are trying to say, that if you can earn the profit while lending, and the same thing, if we take into account, the risk will be that B fails to repay the loan. And what will happen? Not only you will lose these 1000 rupees, but the potential profit is also lost. And that is the reason why we always see that banks charge credit risk premium, that we could have made profit over and above the principal amount. Since the B party is unable to repay the money back to the bank, now we want the credit risk premium also aligned while calculating the MCLR. So yes, that is one of the component which the banks often take into account. Now comes the exemptions to the benchmark based interest rate. So the Government of India schemes where the banks have to charge interest rates as per the scheme. So directly when we talk about the rates at which banks are providing the loan, if they are determining the rate of interest also, they can, but not for these particular situations where the Government of India schemes are to be implemented and the banks have to charge the interest rates as per the scheme. Fine, the banks are already directed by the Government of India that you should charge the rate of interest as per this particular scheme. Like we have the PM Vishwakarma scheme, fine, there the banks will be charging fixed amount of rate of interest, fine, 13% is the interest listed there, but the effective interest is way much less. Then we have the working capital term loan, the WCTL, funded interest, the term loan FITL, granted as part of rectification or restructuring package. So you must have heard in your branches also that there are certain FITL loans. What are those loans? Just a particular amount provided to those parties who were unable to repay their dues, and in order to settle those dues, as a part of restructuring package, we are providing a term loan to them, and this term loan will have a fixed rate of interest. You cannot determine on your own. The banks cannot determine them on their own. Then loans granted under the various refinance schemes formulated by Government of India or any government undertakings wherein banks charge interest at the rates prescribed under the schemes to the extent refinance is available. For all those loans where the refinance option is being explored, again you cannot have your base rate calculated within your bank. Whatever the RBI decides, that will be the rate of interest. Next we have some more categories. Advances to the banks depositors against their own deposits. This we have seen when we were talking about the base rate. Banks' own employees, including the retired employees. Advances granted to the chief executive officer or the whole time director. For that also you cannot just calculate your own benchmark lending rate. Loans linked to the market determined external benchmark rate. The fixed rate loans of tenor above 3 years. All these are also not at all allowed to have the exact benchmark rate which can be decided by the banks. Okay, so since the market rate is ultimately the external benchmark rate, or for that matter the repo rate, there you won't be able to follow your own benchmark based interest rates. Now when we talk about the linking of various interest rates to a singular or the external benchmark rate. So linking of lending rates to your external benchmarks. This was recommended via which study group? So internal study group of RBI reviewed the MCLR system and recommended switching over to external benchmark based rate in a phased manner with effect from 1st October 2019. And who was heading this particular group? Just now we have seen the name, we have discussed the name while discussing the topic of EBLR. Do let me know in the chat section what is the name of the chairperson of this internal study group. Okay, fine. Let me just see. Okay. Fine. Now let's move on to some of the norms which we have discussed while differentiating between your MCLR and EBLR in a bit detail. Although we'll be covering them in IFS also, but let's have the discussion here as well. So when we talk about the basic norms for external benchmark based rates, all the new floating rates, personal, retail, floating rate loans extended by the banks to MSEs, micro and small enterprises, with effect from 1st October 2019, and floating loans to the medium enterprises as well. Fine. So the loans extended to MSEs as well as the medium enterprises with effect from April 1st 2020 shall be benchmarked to the one of the following. So when we say that MSME loans are being provided, so you will be surprised to know that micro and small enterprises in our country, they contribute greater than 97%, and the medium enterprises, they are less than 3% only in our country. And that is the reason why the ISG has given you separate timelines for MSE loans and ME loans. So for the micro and small enterprises, October 1st 2019, for medium enterprises 1st April 2020 was the deadline. So it will be based on what? The EBLR will be based on RBI's repo rate only. Along with that, there are 3 more measures with which you can link the EBLR. First one being the treasury bill of Government of India. Again, 3 months treasury bill yield will be there, and the yield will be published by FBIL, your Financial Benchmark India Private Limited. Then the third benchmark can be your 6-month T-bill, Government of India 6-month T-bill, which is again published by FBIL. And the last parameter can be any other benchmark market interest rate published by the FBIL. So do you think that this private limited or a private company can decide that what can be the benchmark for the EBLR? Answer is clearly no. It will do so. It can publish the EBLR, but with consultation of RBI and Government of India. Fine. Apart from this, the banks are free to offer such external benchmark linked loans to other types of borrowers as well. Right? Not only the MSMEs, not only the personal retail loan applicants, but also to other applicants as well. Adoption of multiple benchmarks by the same bank is not allowed within a loan category. So always remember, if your bank is providing EBLR as the benchmark lending rate for home loan, then it cannot utilize MCLR also. Why? Because it will ultimately do what? You will be finding a competition between two types of lending rate, leading to market confusion also, and some speculation can also happen. So in order to avoid such things, RBI has specified that no two loan categories should have, no two benchmark should be there in a single loan category. Each loan category should have its own singular benchmark rate. Okay. And when we talk about the transition, so more or less the transition was also decided, pre-decided we can say, by the RBI from MCLR to base rate or BPLR. So existing loans and credit limits till the repayment or renewal, right? All those transitions which we are talking about from BPLR to base rate to MCLR, how the transition will be there towards your EBLR. So all those external benchmark linked rates will be there for the existing loans and credit limits till the repayment or renewal. Your limit is about to get renewed. Once it is required to be renewed, then you can change the benchmark to EBLR. Floating rate term loans sanctioned to the borrowers who are eligible to prepay a floating rate without prepayment charges shall be eligible for the switchover to external benchmark without any charges or fee except for a reasonable admin or legal cost. So all those floating rate loans which are already being sanctioned to the borrowers, and if they are eligible to prepay that particular loan without any prepayment charges, then yes, they can freely switch to the EBLR by only giving some nominal fee of your admin cost. Then we have other existing borrowers shall have the option to move to external benchmark. Fine. Other existing borrowers also have the option which are not listed here. The switchover shall not be treated as the foreclosure of the existing facility. You cannot say that since the benchmark has been shifted to EBLR, now the benchmark while doing the documentation was MCLR, so the entire loan agreement is null and void. No, nothing like that will happen. The loan will continue with the new fresh EBLR. Okay, fine. So yes, this was it for today's class. I hope that you are now able to understand that how the rate of interest works in our banks, be it the MCLR or for that matter EBLR. The base rate or the BPLR are not that important for our exam because they are no longer in existence in our country. Fine. So yes, if you want to have more discussion around the topic, or for that matter you have any thoughts that you want to share or any doubt, then you can join my Telegram group also. You can directly scan this particular QR and join the group as soon as possible. Plus, if you are willing to have a structured approach for your examination of JAIIB for May 2026, then we have dedicated courses on our website, and how you can access the courses via calling us on 0981 981 9247. This is the helpline number for all our bankers. Alternatively, you can directly go to our website and enroll in the course which you want to enroll. But I would highly recommend that you must call on this number because they will guide you in the best possible manner that which course suits your level of preparation. Fine. And in case you want to know the maximum discounts, or for that matter the discount code for the maximum discounts, it will be Y1003. You can apply this discount code and avail the maximum discount which is available on our courses. Okay, so this was it for today's class. I hope that you will be revising this particular lecture and joining me again in the next class of PPB. If you have any doubt related to whatever we have studied today, feel free to ask me in the comment section. See you guys in the next class. Goodbye.